All right, let's dive right into this explainer. Today, we're putting on our expert investment analyst hats to unpack the fundamental investment case for an emerging mid-cap medtech company called Artivion. Their ticker symbol is AROT. We're going to run this company through the legendary valuation frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and top it all off with a discounted cash flow, or DCF, analysis. We really want to see if the hard numbers actually match the company's ambitious narrative.
So, we're kicking things off with a massive mystery. According to a May 2026 SEC filing, Yarger Wealth Strategies suddenly made Artivion their #1 holding, and we're going to figure out exactly why. Look, this stock had been trailing the broader market pretty significantly, yet this fund just swooped in and scooped up over 634,000 shares. To understand this move and to figure out what it means for anyone evaluating the medtech space, we need to look way beyond the surface and dig into the actual intrinsic value of the business.
Here's our roadmap to decode this history. First, the top holding mystery. Second, Artivion's core business. Third, financials and cyber resilience. Fourth, the innovation pipeline. Fifth, key risks to watch. And finally, the final verdict.
Section 1. The top holding mystery. Let's see how this bold investment strategy builds. Keeping in mind Peter Lynch's advice to strictly monitor institutional ownership and insider conviction.
Get this. Out of a portfolio built almost entirely on broad ETFs, Yarger allocated a staggering 9.35% of their reportable assets to just this one individual stock. In the Peter Lynch framework, a highly concentrated bet like this from an institutional player on a seemingly beaten-down stock, that's a flashing green indicator. It really suggests they see an asset play, a turnaround, or maybe a stalwart growth phase that the broader market is currently mispricing. When you see a 9% concentration, it's a massive signal to pay close attention.
Moving on to Section 2, Artivion's core business. To understand this level of conviction, we have to evaluate the moat they've built in the cardiovascular space. This is exactly where we apply the Warren Buffett lens, looking for that wide, defensible economic moat.
So their flagship product is the Onyx mechanical heart valve, and it is backed by some truly incredible clinical data that's rapidly expanding its addressable market, especially to younger patients. Why? Because it allows patients to be maintained on a much lower dose of blood thinners, which actually reduces major bleeding by 87%. It literally has a completely unique clinical profile. In Buffett's eyes, this proprietary tech, which is heavily protected by patents and rigorous FDA approvals, constitutes a massive, highly defensible economic moat. It translates to high switching costs for surgeons and very sticky revenue.
And looking at their diversified portfolio, it's super clear they aren't just a one-trick pony. They offer a comprehensive suite of solutions for complex aortic repair. Their BioGlue, for instance, has a massive global presence, and their Synograph tissue processing literally has zero competitive alternatives in allografts for certain procedures. For Buffett, dominating these highly specialized niche markets spells immense pricing power.
All right, Section 3, Financials and Cyber Resilience. The crucial point here is whether these great products actually translate into great financials. We're going to bring in our DCF models and Peter Lynch's growth categories for this one.
Over the last 5 years, Artivion has delivered incredibly consistent double-digit revenue growth. We're talking an expansion from $253 million in 2020 all the way up to over $441 million for full year 2025. Now, for our DCF base case forecasting, a pretty conservative 10 to 12% free cash flow growth rate over the next 5 years, driven by their strong 64% gross margins and consistent EBITDA expansion, starts to yield a very attractive fair value per share. Plus, with Q1 2026 revenue hitting $116 million and earnings per share finally flipping positive, Peter Lynch would definitely categorize this company as a steady, fast grower.
You have to look at the stark contrast here. Despite a severe cyber attack in early 2024 that completely crippled their tissue processing and caused an immediate $4.5 million revenue hit, management somehow sustained demand, expanded margins, and, get this, actually raised their full-year EBITDA guidance. They cleared the backlog entirely by Q3 2025 and maintained 32% year-over-year adjusted EBITDA growth. This speaks directly to Warren Buffett's criteria for honest, highly capable management. They optimized operations during a massive external shock, prioritizing long-term owner earnings over short-term panic.
Next up, Section 4, the innovation pipeline. With those cyber headwinds in the rearview mirror, let's map out the pipeline catalysts that will drive those future cash flows in our valuation models.
When we look at their recent timeline, the puzzle pieces really snap together.
Right after reporting a phenomenal Q1 2026, they secured FDA approval for their NEXUS system in April, and then finalized the acquisition of its manufacturer, Endospan, in May. These aren't just your standard product launches. They are massive expansions of their total addressable market. If we run a sum of the parts valuation, breaking the business down into its individual segments, just the inclusion of the massive Chinese market for BioGlue rolling out in the second half of 2025 adds a highly profitable, long-term revenue stream.
And that NEXUS FDA approval, it's an absolute game changer. It unlocks an estimated $600 million global market for minimally invasive aortic arch repair. To put that into perspective for a discounted cash flow model, calculating the terminal value, which is essentially the value of the company into perpetuity, relies heavily on these long-term market opportunities. By transforming what used to be open chest surgery into a minimally invasive procedure, NEXUS gives Artivion a clear pathway to perpetual growth in this segment. That significantly elevates their intrinsic value.
Section 5. Key risks to watch. Look, a truly expert analysis has to be balanced, so let's objectively examine the risks threatening this growth story, consulting Benjamin Graham's Defensive Investor Checklist. We definitely have to keep a close eye on a few things. First, their ability to flawlessly integrate that $135 million Endospan acquisition. We also need to watch for regulatory delays, like navigating evolving FDA bench testing standards that push their AMDS system approval to mid-2026, along with managing donor tissue supply chain bottlenecks and their overall debt leverage. Actually, from a strict Benjamin Graham perspective, Artivion fails the defensive checklist. Graham demands strong earning stability, a moderate price-to-earnings ratio, and a dividend record. Artivion pays no dividend, and they carry a net leverage ratio involving significant convertible debt. So Graham would argue that the current price lacks a deep traditional margin of safety based purely on historical book value and trailing earnings.
Finally, Section 6, the final verdict. Let's pull all of this data together into a final synthesis to evaluate the fundamental investment case across our different models.
All right, so here is our synthesis based on the fundamentals. As we mentioned, Benjamin Graham would likely classify this as an avoid right now. His intrinsic value formula, the square root of 22.5 times EPS times book value, yields a figure below the current share price due to their minimal historical net income. But Peter Lynch, he'd likely call this a hold or maybe a cautious buy. He'd definitely note the explosive forward EPS growth, but keep a wary eye on the high PEG ratio sitting around 2.5. Warren Buffett, conversely, might see a clear buy. He'd look right past standard GAAP earnings to the actual cash generated, recognizing a deeply entrenched economic moat, exceptional management, and an enterprise value multiple that is rapidly compressing as they scale. And you know what? Our DCF model entirely agrees with the Buffett approach. If they capture even a fraction of that $600 million NEXUS market, the current stock price is sitting at a really healthy discount to its future cash flows.
So ultimately, you have to ask yourself, does a highly defensible medical moat and explosive pipeline catalysts justify the risks inherent in a mid-cap medtech stock? Yarger Wealth Strategies clearly ran their own models and decided the answer was a $25 million yes. Based on the wide moat and future cash flow projections, the numbers definitely make a compelling case for growth. But the real question is, what do your models say?